Hi, thanks so much for tuning in. You're watching BQ Prime. My name is Alex Matthew, and this is an earnings conversation. We're speaking to the management of RateGain Travel Technologies. This is a software as a service company that operates in the travel and hospitality space. Joining me is the chairman and managing director of the company, Bhanu Chopra. Bhanu, thanks so much for taking the time and speaking to BQ Prime, and congratulations at the onset for the first full year of listing. Let's talk about the quarter gone by, though, and I see that there is growth across all the metrics. But tell me what stood out to you. I'm personally quite curious about the integration of Adara and the revenue contribution there.
Absolutely. So first of all, thanks, Alex, for having me on the show. And as you rightly noted, it was the best quarter ever since we've actually gone public, and right across all our three business lines, which is DaaS, distribution, and MarTech. We had some incredible growth. Specifically on Adara, it was our first quarter because we acquired the company in the first half of January. And our really focus initially was to consolidate the position and really clean out the balance sheet. So, the company was loss-making, had a bunch of debt. So we cleaned all of that out, gave it fresh oxygen, and really, we're trying to now revive it to sort of the glory days of pre-COVID because the business took a significant hit. And we are now sort of, given the fact that we've consolidated the base, going back to the customers because the platform's already built, and trying to revive a lot of those conversations. So I'm happy to report that project went extremely well. The integration was pretty smooth and seamless. Our initial goal was to break even at that company level, but we actually made a little bit of EBITDA as well. And talking about RateGain Core, I think it was a tremendous quarter for us. Like I said, we witnessed huge volume growth amongst our existing clients. We signed up a bunch of new clients. It was almost a 25% growth on our new booking numbers year on year. And given the fact that we made a lot of investments over the last 2 years in new AI-based products, we're now beginning to see some traction on those products because we were, trying to find the right product market fit, and also, wanted to establish some key success stories with some of our initial clients. And it's, I'm happy to share that we're making very, very good progress on that front as well.
Understood. One specific metric that I focused on from your investor presentation is a 68% increase in revenue per employee compared with FY22. And I see the point that you were making about the addition of clients as well, 292, if I'm not mistaken, in the fourth quarter itself. So I'm curious about this because this is indicative of very high operating leverage, but is that something that you can keep going with that kind of 17% increase in employees and a significant increase in the number of clients and the share of revenue? Is that sustainable?
Yeah, so, something that I've been speaking all throughout since we've gone public is the advantageous business model that we are in, which is software as a service, where every incremental dollar that you earn, actually, a lot of that flows through into your EBITDA. So it's a completely non-linear model to your traditional IT services companies where, basically as you add on more customers, you have to bring in more people to build to the specs of what your client wants. Whereas in the case of SaaS companies, especially RateGain, we've already built the product. So a lot of effort goes into just acquiring that customer. But once you acquire the customer, the machinery is sort of auto set, and then you can provision and service the customer actually in a matter of, hours, not days, weeks, or years, as opposed to the IT services. So, I'm happy that you noticed that metric because when we went public, we talked about 200 to 300 basis point improvement every fiscal year for the next 5 years. So we were about 8-9% when we went public, and we wanted to aspire to get to 20% in the next 5 years. But I'm happy to report that we are exceeding that metric quite significantly, because this last quarter was 17.6% EBITDA margin, and overall, even for the year, it was about 15%. And we will continue to expand on these margins by 200 to 300 basis points. In fact, Alex, I'll share with you that most of our business lines that are mature, we make actually north of 30% EBITDA margins. But the headway for growth is so much that we want to continue to reinvest in building new products and also accelerating our sales and marketing infrastructure. So as an example, over the last couple of months, we've added a bunch of sales folks in US, in Latin America, in Asia, and there's obviously going to be a lag on seeing the results of adding those people. But I'm quite confident that should continue to accelerate our growth even in the upcoming fiscal.
I want to focus on MarTech, because that's where Adara comes in as well. And I think you were referring to cleaning up the balance sheet over there and ensuring that you remove or you prune those low value or low margin customers. Is that more or less done? And what can we anticipate in terms of the revenue contribution and operating performance in the current financial year?
So, Alex, when we acquired the company, they were at a run rate of about 25 million and making losses. So, as I stated, we within the last quarter itself we were able to break even, actually make a little bit of an EBITDA, and I'm pretty confident that even in the upcoming fiscal, what we've guided for in the past is about a 15% growth in that business and a 15% EBITDA. And look, we are now 5 months into the acquisition, and I have to state that those stated objectives, we are exceeding them. So I continue to be very, very bullish. And like I said, this was a $100 million business, which temporarily took a huge hit, which all our businesses took during COVID days. And now that we're, nobody even talks about COVID anymore.
Yeah.
So, we're in a very, very good position to go back and leverage that platform to reactivate a lot of those customers that we had, and we're seeing some very, very good progress there. So I'm quite bullish on exceeding the numbers or the stated goals that we have for Adara as well.
Okay, so I see that so it's in your investor presentation, strong pipeline, all of that. You've spoken about why SaaS is different from traditional IT services, and it's also the space that you operate in, right? Travel and hospitality. Would you say, therefore, that the worries or the concerns that are currently afflicting the wider IT universe don't really affect you? You're relatively insulated from that. And from that lens, how can we expect FY24 to pan out?
Yeah, so look, you're absolutely right. I think what the pandemic did was it caused a fundamental shift in consumer behavior, right? So, we saw the advent of revenge travel. And even now, I see the whole travel demand being quite robust. And I think given the consumer behaviors change from acquiring things to acquiring experiences, we remain quite bullish, and I would say cautiously optimistic also, because, to go as far as that we'll be insulated from all the craziness that's happening around the world is, stretching too much. But if I look at everything that I see today, I feel very, very, confident that FY24 should also be a spectacular year. And something that we've talked about already is we're expecting about 55 to 58% growth, and also continued margin expansion from going from 15% margin to about 17% next year.
Fantastic. Okay. Now, finally, on investments and on attrition, in the IT universe as a whole, 20% is kind of the norm, but you have a relatively much smaller base. So do you anticipate that will cool off just a tad bit as we speak? And I understand that you're investing in AI, so is everybody else, but then what can you tell us about that?
Yeah. So attrition has definitely come off. We were at, and just like our peers also, at 24-25%. We're down to like about 21%. And given the current environment and the funding winter, especially on the private market side, I do feel like the war for talent is not as intense as it used to be. So and also in terms of retaining employees. So I do feel that this is less of an issue for us, and our HR team does a fantastic job of the number of HR programs that we are launched and building leadership and also cultivating talent at RateGain. So I feel pretty good about the supply chain on getting talent. And you're absolutely right. We are spending. I think AI is now sort of the flavor of the season for investors, but we continue to invest in AI, and we have been doing it for a number of years. In fact, a lot of our products like Rev AI, Content AI, Demand AI, they were all built on the fundamentals of AI. I also see now a huge opportunity with generative AI, and especially on our MarTech business. So there are some additional investments that we are doing there. But like I said, given we've solved for these supply chain issues for talent, and we recruit heavily now on campuses as well, and have a new batch joining us in July. I think we are fairly well covered to go on and meet all our objectives for the upcoming couple of years.
Fantastic. Bhanu, pleasure speaking with you. Thanks so much for taking the time and speaking to us on BQ Prime, and look forward to the next chat already.
All right. Thanks, Alex. Thanks for having me. Bye.
All right, viewers, that was RateGain speaking to BQ Prime. There's lots more coming up over the course of the day, so do stay tuned. This is BQ Prime.